99.99% of all of you start your money in a bank account. Too many of you leave your money in the traditional bank for too long. But what we're doing, folks, is we're creating a system, a process called the infinite banking concept, and that is just made better with compounding interest.
If you're working with a direct recognition company and you take a loan, dividends can be impacted.
You're in control of all this, and all you got to do is act as if you are the bank. Welcome everybody to Wealth Webinar, the first episode of 2025. So welcome to a new day and, well, for some of you, a new year. But like I was saying earlier, all I like to focus on is what we are doing right here, right now. And the one thing I do know, when we go into a new year like we are now, 2025, we start kind of thinking in our minds, what do I have to do to get ahead? What are the things that I want to accomplish in 2025? You know, most of us write down all of our goals. Maybe we reflect on what our 2024 goals were. Some we did, some we didn't do, some we accomplished, some we didn't. Doesn't matter. Forward progress is forward progress. And hopefully all of you can say that you moved forward. But with that being said, with this reflection, I think this topic that we're going to talk about is pretty interesting. And in the reflection, I think the best way for me to sum it up is I want to talk about some fundamentals. I want to talk about history, and I want to talk about mechanics. Okay, those are technically the three high-level things we're going to hit for this first episode of 2025. And a lot of it is not going to just reflect on the last year's planning, and a brighter financial future. What we're going to literally do is real quick, I want to take you back, way back in history, and I want to talk about what happened back then. And there's a unique thing, because when we're thinking about our year, we're thinking about our finances. And if any of you are brand new here, please, in the chat, if you would, put new or put first. I just always like to give a big shout out to all our first timers. And every single week we get new people. We've been doing this webinar now, gosh, I don't even know, 7, 8 years. Never missed a Wednesday. That's a commitment, but that's just what we set out to do. And we bring financial knowledge, and we don't expect anything from any of you. If we can solve your problem, great. Maybe you'll book a call with us, with one of our mentors, to see how we can solve your problem. But nonetheless, this is all about you folks. It's about you giving me your time and being here today. So I appreciate all of you. We got 106, great start. Normally we'll see anywhere between 100 and 200 people a week. But let's go way back in time, okay? A long, long time ago, people had the same goals you do. Yes, maybe different. Maybe they weren't buying cars, they were buying horses. Maybe they weren't, looking to build their new business. Maybe they were looking, how do we make our farm a little bit more efficient? Doesn't matter. But hundreds of years ago, the folks back then had the same goals that you have today, and that was a better life. They wanted more time in their life. Okay, they wanted a better life. They wanted more finances in their life to do the things they had. They had the same visions and same dreams that many of you do that are on here today. And they all had to make some decisions. They had to decide, where are we going to put our money? Think about that. Isn't that like the fundamental? That's where it all starts, right? Where are we going to put our money first? Well, let me kind of sum that up. Back then, it was probably not much different than today. The brainwashing still existed. It is when we got paid money, we have been taught to rush over to the bank and deposit the money in the bank. Now, back then, they physically took the money, maybe gold coins or whatever it was, and deposited them in a depository called a bank. Today, you just push some buttons, go on your phone, like, let's see, I'm going to do this, take a picture of your check, boom. Or many of you, it just gets automatically deposited right into your bank account. None of that matters, but back then, there was some interesting things that people were starting to learn about, and that was a safer, better place to put their wealth. So when you think about a safer, better place to put your wealth, what are the places you think? Where would you, if I said, what is a safe, good place for you to store your wealth? Somebody said a Roth IRA. That's an interesting one, because a Roth is literally not a place to store your wealth, or a thing you put your wealth in. It's really just a component of an IRS code. So a Roth IRA, a traditional IRA, a 401k, 403b, it's really what you put your money into inside of the Roth IRA. But okay, I like that because Roths are tax-free. So you put after-tax dollars in and it's tax-free when you take it out. There are some rules and lots of things. Okay, Ray said gold and silver, not bad. It's a good storage of wealth long-term, and definitely a good place to put your money in an inflationary period, which I would come to say that right now that's a good time. Let's see, good old days, fill up that 401k. Again, 401k is just kind of it's more of an IRS code, and inside the 401k you would have mutual funds. So that's kind of more what I was looking for, is like inside the peanut shell, what is it that you got? Like, where is the safe place? We got revenue producing assets. Okay, revenue producing assets can be risky though. Julie Robertson said real estate. Yes, real estate can be a great storage of wealth, especially long term. So we're going to keep going on. Somebody said horses. Yes, horses are definitely not a bad place and not bad to look at, and they can be good companions. Jeff Green said stocks, and Drew said T-bills. All perfect. But back 100, let's go back 100. We'll go the earliest, 135 years ago. Many of the things that you all just mentioned didn't exist, but there was something that existed, and there was something that many people back then chose to store their wealth in, and that was giant, let me preface this, mutually owned life insurance companies. Now, I want to read you something because this is interesting. And when we're talking about life insurance, back then there was one kind of life insurance. Can anyone tell me what kind of life insurance there was 135 years ago? Or actually, let's go further back, 173 years ago, which is the oldest insurance company that we're going to talk about today? That's right. Tess said whole life insurance. There was one kind of life insurance that existed 167 years ago. Today, there are, I'm not going to say 100, but there are lots of different life insurance companies. But let me read you this. This is what they call the origins of life insurance dividends. And I found this interesting. Life insurance dividends trace their roots back to the establishment of mutual insurance companies in the 18th and 19th century. These companies were created to serve policyholders. Pay attention to this. Created to serve, I love that word, serve policyholders as their primary stakeholders, ensuring that their surplus profits would benefit those who contributed to the pool of funds, which is the policyholders. The idea of dividends emerged as a way to return excess funds generated from the conservative investments, operational efficiencies, and lower than expected claims. This practice made life insurance not just a financial safety net, but also an incredible tool for wealth growth. When I read that, it's interesting because when I asked everybody to tell me a safe place, a safe storage of wealth, did you notice not one person said whole life? Now, that doesn't surprise me in any way, shape, or form. It doesn't surprise me at all. When we think of a safe place to put our money, we don't think of whole life insurance as a safe place to put your wealth. But 167 years ago, that was the place. And that was the place for literally the better part of 100 years, until literally the 1980s. Whole life was like the cat's meow. It was literally that was the place you stored your wealth. Number one, because mutually owned insurance companies were aligned with policyholders. And instead of a stock company, which I'm going to talk about in a second, mutually owned companies, okay, which are the only insurance companies we work with, they operate on a principle of policyholder ownership. So let me ask all of you a question. I'm sure some of you own whole life insurance, and some of you own whole life insurance with a mutually owned company. Do you think of yourself as an owner of that insurance company? Probably not, right? You're probably like, no, that company's worth hundreds of billions of dollars. I'm just a peon. I'm not an owner. But do you realize that the way that company's organizational structure is, being a mutually owned company, you are an owner, because that's how the company is built. And I'm reading it literally right out of the bylaws here. Mutual companies operate on the principle of policyholder ownership, meaning their profits, meaning the insurance company, their profits are distributed to policyholders in the form of dividends. So today, a lot of what we're going to talk about are dividends, because we all love dividends, right? This structure inherently aligns, pay attention, this structure inherently aligns the company's goals with the financial well-being of the policyholder. How many of you want to put your money with a company that aligns with everything I just said? Forget about the fact that it's an insurance company. Let's say I didn't tell you it was an insurance company. And let's just say, hey, there's this company out there that operates on the principle that you we'll call you the policyholder here as the owner, and that their profits are distributed to the policyholders in the forms of dividends. And the structure of this company is inherently aligned with the company's goals and your financial well-being. That's literally what mutually owned insurance companies are all about. And that really should strike a chord with every one of you, because now let me read you how a stock-owned company works. Fidelity, Vanguard, BlackRock, Principal, AXA Financial, any of the IUL companies that you would see out there, all of them. Let me read you how a stock-owned company views you, the policyholder, or you, the individual. A stock-owned company prioritizes shareholder returns, which can sometimes lead to decisions that prioritize profits over policyholder benefits, such as higher premiums or lower dividends. So in other words, a stock-owned company is going to prioritize some stockholder who you don't know, you don't care about, somebody that doesn't give a shit about you, and all they care about is more money, stock price going up. Don't pay the policyholders dividends, pay us more dividends. Increase the policyholders' premiums because we want more money because of greed. The stock market world, I was a financial advisor for 16 years. I can vouch. Wall Street is not out for your best interest. Wall Street is 100% a greedy mother effer, and that's all they care about is taking care of themselves. Isn't that very different from an ethical and just a pure operational standpoint? Do you think those two companies operate differently? Do you think they invest their money differently? Do you think they do things differently as a company? Absolutely. A mutually owned company and a stock company are operated completely different, which is why often when I'm doing videos on IULs, and I'm not saying anything good or bad, and this isn't about IULs today, but I do tell people, I say, when you buy an indexed universal life from an insurance company, know that that insurance company is putting all the risk on you so that they don't have the risk on them. When you're buying a whole life insurance policy from a mutually owned life insurance company, this is 100% factual, the insurance company is taking on all the risk so that you don't have to. Which company do you want to do business with? It's an easy decision there, right? When you put it that way, Chris, I guess it's a pretty easy decision. Now, let me go one step further. Milestones and dividend evolution. I want to really focus on the dividends because remember, the dividends are the way that the insurance company, mutually owned insurance companies only, share the profits with the policyholders, the owners of the company, which are the policyholders of the company. So hold on, let me pause real quick. How many of you have ever gone into a traditional bank and done business at a traditional bank? So you understand that experience, a stock-owned traditional bank, like let's pick on Bank of America. But then you've also gone into a credit union that you are a member of. What's the difference? Anyone ever feel different? You walk into the credit union, you walk into the traditional bank. Which one makes you feel better? Put it in the chat. Which one makes you feel better, the traditional bank or the credit union? Of course, 100%, completely different, somebody just said. Shane said, completely different at the credit union. I do business with a credit union, Cornerstone. When I walk in there, the feel, the way I'm treated, the way I'm handled, the way my accounts are handled, the way that they help me, 180 degrees different than a traditional bank. Why? Because you are a member, technically an owner of that credit union. True and true, like you really are. A credit union is member owned. It says it right on most of their walls. You walk into Bank of America, does it say, welcome owners, welcome members? No, it says, piss off, the coffee's burned, but you're gonna like it. Sit down, shut up, and we'll get you when we want to.
Yeah, but Chris, you still get a dum-dum sucker.
Oh, dum-dum sucker. And you know, the funny thing is, every time I've walked into Cornerstone Federal Credit Union, I've never seen a dum-dum sucker. But I have yet to walk into a traditional bank and not see a dum-dum sucker. What are they trying to tell us? But anyway, getting back to the key milestones of dividend evolution, and we're going to get into the point because some of you are like, come on, get to the point. This is the point, and it is a very important one because you need to align yourself with companies that care about you, companies that want you to succeed, and companies that are built and designed for your benefit. And I can promise you the majority of the people out there are not aligned with the companies that they're putting their money with. I promise you they are not. So right down here, the evolution of dividends. Early life insurance companies predominantly offered whole life insurance policies with guaranteed cash value and dividends. They were seen as a way to blend protection with wealth accumulation. This is the old ones. Now, when I say old, let me just talk about a couple names. And I very rarely ever use insurance companies' names, but I'm going to here. So here are the companies that we work with, all mutually owned life insurance companies, but all very different mutually owned life insurance companies. First, starting with One America. We have a great relationship with One America. One America was founded in 1877. Anyone that old here? 1877. That's a 147-year-old company. How many times do you think they missed dividends? Anyone? How many times do you think One America missed paying a dividend? That's right. Troy said 0. Shane said 0. 0. Never. They never, ever have missed one. Not through the Great Depression, not through the Great Recession, not through the pandemic. Never, ever, ever have they missed a dividend. Hold on. Let's keep going. Lafayette Life Insurance Company is another company we work with. They've been around since 1894. That's a 135-year-old company. That is I guess the young blood of the group. Like that's the newest of the insurance companies we work with, 135 years. How many times do you think they missed dividends? 0. Let's keep going. Security Mutual, been around since 1877. That's 137 years. How many times they missed dividends? 0. Guardian, been around since 1860. And I'm going to call out Guardian and I'm going to kind of hold them on a different platter because they are very different in the way that they operate from a dividend standpoint than One America, Lafayette, and the Security Mutuals. But Guardian has been around since 1860, a 164-year-old company. How many times they missed dividends? You got it, 0. And last but not least, Mass Mutual. We don't use them a ton, but they are a great insurance company that we have used for many, many of our New York clients. They have been around since 1851, a 173-year-old company, which has never, ever missed a dividend. Why? Well, when you go back to what I was reading you earlier about how these companies are actually built and structured, you would understand mutual companies are structured so that their profits are distributed to policyholders, and their structure inherently aligns the company's goals with the financial well-being of policyholders. So it should come as no surprise that none of these companies have ever missed a dividend.
As we walk down history lane, thinking about the Great Depression, the bank holiday in the 30s when they shut down banks because there's a run on the banks. It's just always phenomenal to me to think about those times, world wars, when the banks are failing and these mutual companies are still paying dividends. That's what blows me away about this. It really shows the strength of these companies. But just want to throw that point in there. The other thing too, although there are ways to have a policy that is taxable, how many times do you get a 1099 at the end of the year for your dividends? Because those don't happen as well. So those dividends are growing tax-free, and so that's always a benefit as well.
All right, I messed around with some of the settings there, Craig, so hopefully the echo's gone, but you nailed it. I mean, I had to take a trip back in history, folks. Because the one thing that's changed from 1897 or any of those years that you just heard me mention till now is today there are lots more options, but also there are lots more people trying to get your money and trying to lure you in with all the wrong things. But at the end of the day, one thing we have to all figure out, and this is an important thing, is where do you want your money to go first? I'm not talking about where your money goes next. Listen, like all of you had different things. Like some of you are real estate investors. Some of you love stocks. Some of you might be an options trader. Some of you invest in horses and in other things that you're passionate about. Like I invest in cars. Like there's every one of us have different things that we invest in because we know, like, and understand them. That makes us unique, but none of us are any different from the first step, and that is our money has to start somewhere. It has to go somewhere before you buy the car. It has to go somewhere before you invest in stocks. It has to go somewhere before you put the money in the 401k, the Roth IRA, the traditional IRA. It has to go somewhere before you buy real estate. That is the only thing I am talking about today, is where does your money start? 99.99% of all of you start your money in a bank account. But too many of you, I will call you out, too many of you leave your money in the traditional bank for too long. I'm not saying it's wrong to start in the bank account. My money starts in the bank account. It has to. But my money goes to a bank account and I very quickly get kind of itchy and scratchy. The more money I see sitting in a bank account, the more I'm like, oh my God, oh my God, oh my God, there's a problem. None of you feel that way, do you? None of you look at the accounts in your bank and say, oh, that's a problem. But it should be. Because how much is your bank account, your checking account, paying you in interest? Because mine's zero. Anyone else getting more than zero in your checking account? How much money do you got in your checking account? Don't put that in the chat, but I want you to just think about that. How many of you have more than 25 grand sitting in a checking account? I bet a lot. I bet a lot of you. Okay, Troy said he's getting 4%. Troy, you're getting 4% on a checking account or a savings account? Because I'm only talking checking account, bud. Because I got one person that said 4, Anthony said 4.5, but I think Anthony and Troy are referring to savings accounts, high yield checking account. That's interesting. Okay, I very rarely hear that. And then Anthony said high yield savings account. So I didn't talk about savings accounts. So, a lot of us, if you've got more than 25 grand or whatever your emergency fund is, let's call that 6 months of income. If that's more than that sitting in a checking account or a savings account, you really need to start thinking differently. And you need to get that money out of that account and into an account where it's actually going to serve you. So I love that Troy said a high yield checking account. Troy, if you wouldn't mind, can you share what bank you have that's paying you 4% on a checking account? That's very unique. One of the things that we are doing right now, folks, and a little transition here, so just let's pause and put a needle in that while Troy responds. We are building a company called PMC Wealth. Okay, it's a registered investment advisory. And one of the biggest things PMC Wealth is going to do outside of giving investment advice on a retainer basis, very unique in the industry. Our job and goal is not going to be to custodian or to raise and put money under management and invest your money. Our goal is going to give you investment advice based on your needs and goals. That's it. You pay us a retainer for that. Secondarily, the other component of what PMC Wealth is going to do is cash management. Meaning just what we just said. I bet you there's a lot of you on here that don't have time to go out there every month and search the universe of banks and high yield checkings and high yield savings and money markets to find the best interest rates. And then I bet you, even if you did have time to do that, you don't have time to switch your accounts and move money over there. And if any of you have more than $250,000 in a savings or checking account or in a bank account, I bet you very rarely are you sitting there trying to think, oh gosh, I gotta go disperse this, so I only have 250,000. But what if somebody else did all that for you? That's what we're going to do. So I'm not going to talk any more about that, but that's just something that's coming because I know everybody has cash, everybody wants cash, everybody wants the best return on cash, but very few people have the time or just the patience to go out there every month and make sure that they're getting the best interest rate, making sure that, like when Troy says, what was that bank? Lending Club, actually they have reduced to 3.7, surprise, surprise. They're reducing along with the Fed, but I bet you not a lot of people have time to sit there and say, oh, wow, Lending Club's paying 3.7 on a high yield checking. I got to do that. But you would if somebody else did all the work for you. How do I know that? Because somebody else does all that for me today. And you see, when I create something, I like to create it based on my own personal experience and my own problems. And then I try to solve my problems. And then I'm like, I wonder how many other people have the same problem I do. And guess what I find out? Everybody has the same problem. But let's diverge back over to dividends because we got a lot to cover and some really unique stuff. And I'm about 10 minutes over where I should be. But basically, the last thing I want to do before we dive into something super fun, because we're on this discussion of dividends, is I want to give you a parable. Shauna came up with this. I thought it was phenomenal. Imagine this, okay? Imagine you go in your backyard, you plant a tree, a fruit tree. Now, that fruit tree, you do this as a New Year's resolution, and that fruit tree starts to grow, and it yields fruit. But there's two fruit trees that you planted. You planted one here on the left side of your property and one on the right side. Exact same fruit tree. Both of them are apple trees, the exact same kind of apple trees. Both of those are similar soil. And both of those trees you planted, you put the exact amount of water, fertilizer. You tend to them identically. Everybody got that, right? Two apple trees planted in your backyard, but there's one unique difference between each apple tree. And we're going to call this direct recognition and non-direct recognition, which is going to pave the way for where we're going next, okay? Direct recognition is the apple tree on the left-hand side. And what does that mean? That means when you walk out to that apple tree and you pick an apple off of the tree, because you're hungry, got lots of apples on the tree, but you take an apple off the tree and you eat it. What you just did on that direct recognition apple tree, which was tended to the exact same way, planted in the same soil on your property, is you just slowed down its future growth because you took an apple off the tree. And you know that every time you go to that apple tree and you take an apple off to eat it because you're hungry, that apple tree is going to grow slower and yield less fruit next year, less fruit the year after. But now let's move away from the direct recognition apple tree and let's move over to the right-hand side apple tree, which is flourishing the same, looks identical to the other apple tree, but this is what's called a non-direct recognition apple tree. Now this apple tree is a little different. When you take the apple off this tree and you eat it, the tree will continue to grow just as it was when the apple was on the tree. Matter of fact, you could take every apple off of that tree, put them in bushels, go give them out to charities, give them to the deer in the backyard, feed the rabbits and the critters back there, and your apple tree will still continue to grow and yield the exact amount of fruit that the other apple tree does. The difference is nothing other than direct versus non-direct recognition. Now let's take that same parable and let's bring that over to life insurance companies, mutually owned life insurance companies that pay dividends. In other words, whole life insurance. There are two types of whole life insurance companies. And real quick, I want to give you both the definition of a direct recognition versus a non-direct recognition insurance company, okay? Direct recognition means that the dividends are adjusted based on how much the policyholder borrows against its policy cash value. This approach aims to align dividends more closely with the company's actual financial position and the individual's policy activity. In contrast, the non-direct recognition company maintains dividend payouts regardless of the policy loans, offering a stable dividend approach when cash value is borrowed. Direct recognition versus non-direct recognition. I thought that parable of the apple tree was the perfect way to sum that up. So Craig, what we're going to do today is we're going to go through and we're going to show you the differences because it does matter. And because a lot of our competitors are out there saying that they're building IBC policies and they're doing this, that, and the other thing. And a lot of them are doing them using or direct recognition companies. And I'm not saying there's anything wrong with that, but if you're going to use a direct recognition company, which Guardian, I'll just pick on them. They are direct recognition, great insurance company. I have policies with Guardian. I have policies on myself with Guardian. And I also have policies on my daughter with Guardian. So clearly, I know something that most of you maybe need to learn because as soon as I told you the difference between the two apple trees, you all only want the non-direct recognition apple tree because you're hungry and you want to eat those apples and give them away and feed the animals and the critters. Now, none of you really want that other apple tree anymore because you're like, well, if I can't eat the apples and if I do, it slows it down. Like, why would I want that? Well, there is a way where direct recognition companies really can perform very well, but you've got to be an honest banker and a very good banker at that. So Craig, let me let you kind of take over here a little bit and go into this. And I'm going to man the questions here for you for a minute.
Sure, absolutely. And all the talk about apples, I'm kind of hungry now, so I may have to disappear and go grab some lunch. All right. So everyone that came in, they got the disclaimer, so we're not going to run through that. But as Chris just mentioned, we went over the differences between direct and non-direct recognition. And if you stick around to the end, even if you have a direct recognition company, there are some other alternatives that you can use called cash value line of credit. So let's stick around. We'll get to that at the very end here. However, I took this right from ChatGPT because unlike Shauna, I didn't come up with a fancy parable, but I think everyone here now understands that if you're working with a direct recognition company and you take a loan, dividends can be impacted. If you take a loan with a non-direct recognition company, your dividends won't be impacted. So there's one thing that I want to mention here is that in different companies that are direct recognition, even though the dividend can be impacted, they sometimes make up for it in interest crediting. So if you have a direct recognition policy, just make sure you know all the ins and outs of how your specific situation works. But what we're going to share today is just kind of what are some of the impacts to the dividends, assuming there's no interest crediting. So just want everyone to understand that. The other thing that I wanted to mention, Chris, about the direct and non-direct recognition is oftentimes direct recognition companies will use fixed loan rates. So from policy year to policy year, your loan rate will not change. It'll be fixed. But a lot of times with the One Americas, the Lafayette's, the companies we work with, that are non-direct recognition, their loan rates are variable and they can change from year to year. So in your policy year, you'll be fixed for that year. But then when your policy year comes up, if there's any adjustments to rates, those can be set for the following policy year. So those are some of the differences between the two. All right. So we're going to run through, before I get into the dividends, what I want to just kind of a quick commercial, quick side path. But for a lot of the folks that are new here, you might be thinking, well, what am I doing with this whole life policy? Because Chris said it's a great place to store your money. It's a place to put your money first before you go do something else with it. And if you're working with our team, one of the things we do is we help people on a day-to-day basis. How do you get control of debt? So you might have credit card debt, you might have car loans, and you can actually use your whole life policy in addition to your debt pay down strategies. And we have a tool and a process we go through that shows you how that works. So step one would be you create the policy, we go after your debts. There's folks that want to do things like the private money club, or they want to put their money into the policy, take a loan and put it into a real estate deal. So we're not giving an investment advice, but we're just saying this is what some folks do. We can actually project out. If you told me that, hey, I'm going to be working with Chris and Chris is going to pay me 12% annualized on my investment, then we can kind of run that out with the policy. And the last thing we've talked a lot about this today is, you might be buying a car, you might be paying for college. What are some of those major purchases? And I had mentioned earlier, we bought a horse. So Gina wanted to do cutting horses. So she's got this fancy horse that goes out and chases cows. But anyway, those are things that you can run through your policies. But now we're going to get into some of the mechanics of how those loans work with a direct recognition company.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. And Craig, before you do that, it sounds like an expensive hobby. Like you buy a horse to go out and chase cows. Cows are expensive. The horses are expensive, and you're buying a horse just to chase the cows. Like, what's the end result?
Well, I tell you what, this is not a moneymaker. Now, some people that actually do this, they go and go to all these different events. They can actually do really, really well. So just in the horse world, Gina used to do things that were a little more proper, and the show horses. These cutting horses, they're just like the Jeeps of the world, barreling through the dirt. But it's incredible what some of these horses bring. The barn that we work at, some guy just bought 3 horses. Is $250,000 for the 3 horses, and he's looking to put a lot of time and training into them in a year. Probably sell each one of them for $150,000 to $200,000. So
what's interesting about that? When I think of horses, I think of horsepower, and you just kind of gave me the sum up of like what 3 horsepower costs, and I'm just looking over here, and I'm like, I got 600 horsepower right here, and it didn't cost that much. But not only that, when we talk about horsepower, I want to talk about the horsepower our money's got behind it too, because that's like the tailwind. And when we talk about these high yield savings or high yield checkings, and we heard, that LendingTree has 3.7 from Troy, and that just dropped from like 4%, and somebody else had 4.3. That's some good horsepower. But when I think of horsepower from these giant mutually owned insurance companies, they've got a lot of time. They've been around a long time, and they've figured things out with conservative investing. They can get a way better return than I could ever get on safe conservative money. So what they actually do, because they are uniquely aligned with our goals, my goals as a policyholder, I'm getting from like Mass Mutual right now, my dividend crediting rate is 6.4, Lafayette's 5.75, very similar to what One America would be. Security Mutual is probably right around there, 5.7, 5.8. I can't remember exactly what it was, but like those are some good horsepowers. But then, when you think of horsepower, and I look at this, or I think of your 3 horsepower that cost $250,000, I think about like what would make that horsepower even more efficient. And I look at this horsepower over here, 608. This thing only weighs a little bit, doesn't weigh much, so it's super efficient horsepower. And then I think about the horsepower behind our whole life policies and some of the nice tax features or tax advantages we get with life insurance is, if I got Mass and I'm earning 6.4, Lafayette earning 5.75, that's tax-free growth of the internal buildup of cash value. So that's kind of like just going out there and just like slicking up the road, and like, we don't need much, man. We just slide. That horsepower doesn't need to work real hard. It's super efficient. So when you're thinking about the returns you're getting on your safe money, that's all we're talking about, remember, is where your money goes first. Taxes make a massive difference. There's none of you that have a savings account or a bank account that don't receive this beautiful thing at the end of the year. Oh, by the way, it's coming in your mailbox soon, called a 1099, which basically says, hey, our bank paid you 4% on your money this year, which is X amount of dollars. Oh, by the way, you have to pay tax on that interest. So did you really make 4% or 3.7 in that high yield savings? No, you made 3.7 or 4.3 minus the taxes you paid on the interest you earned. Where in these whole life policies, if designed properly, that return you're getting on it is tax-free, and that makes a big difference. So I wanted to point that out. I'm not sitting here trying to make a case that whole life is the best thing you can ever put your money in, but I'm making a case that whole life insurance, specially designed and engineered, very well might be the best place you will ever put your money versus other options.
Awesome. Yeah. And actually that horsepower word is something that Gina and I use often because she's a horse fan. I'm a classic car guy, so horsepower works in both situations. But anyway, I love the word horsepower. And just want to do a quick shout out to Sean, who had mentioned that he did some debt payoff with the Debt Blaster. So that's awesome. Glad you guys are getting some use out of that. So this is the use of the policies. These are just a few ways that they can be used. Now the question is, how, what do we do here with these policies? And I like to think of these policies and the designs we do, just like you go in to get a suit. We want to get a tailored suit. We don't want to just buy one off the rack. But we're going to, take every single person's specific situation and understand what you're trying to accomplish, the funding, how you want to fund it. And we're going to build a policy design that's just for you. And so in this example, this is with a company that is a direct recognition. And what I just wanted to show is kind of what it looks like if you were to put in 30,000 in premiums for the first 2 years, and then 10,000 in premium all the way up to year 10. Now, for those of you that haven't been around our campfire, this is what we call a cash value analysis. It's really taking data from the illustration. We have the whole illustration if you want to see that. But we're really just trying to bring forth what is the cash value growth per year. As you put that 30 in, there's 26,140. And one of the things that we track is this thing called cash on cash. So we're really measuring when you put $1 in that year, how much of that dollar do you have access to? We have to remember this is life insurance. There's a little bit of wind up time. And I think just like in the horse world, you buy a horse, you've got to train it, you got to put the time and effort into making that horse efficient before it's going to go out and win shows. The policy, it's going to take a little bit of time for it to spin up and be efficient, but after, say, the 4th year here, we're in the, we're making cumulative more money than we put in. So we've got all the money back that we put into the policy by the end of year 4. And for every dollar we put in the policy at year 4, we're getting about $1.20 back.
That's such an important thing right there, Craig. And I think this is where a lot of people fail to realize the power of this. Like, you put $1 in, you take $1.20 out. It took you 4 years to get there, but for the rest of your life, that's always going to be more than it was the year before. Like, who wouldn't want that trade-off? Like, who would be okay with not making money for 4 years? You're not losing, you're just not making. Okay, I guess you could say you're losing, but you're really going to get it all back. But anyway, you don't have all your money to use in the first 4 years. But then every year for the rest of your life, you are guaranteed to take out more than you put in every year. And every year that number goes up and it starts going very fast. Like, I sometimes just really struggle with anybody that says, oh, that whole life thing is the worst place you can put your money. I'm just like, really? Have you ever really looked at the math? Because call me stupid. Maybe I'm the dumb one. Maybe I'm brainwashed, but that makes perfect sense to me. I'll give for 4 years to get for the rest of my life. Now, somebody that's 80 years old or 70 years old, maybe they're like, I don't have time. I get it. But anybody that's 60 and younger, you got a lot of time.
Yeah, the other thing too, we talk about it, but probably not enough, but is this death benefit over here. So God forbid something happens to Bucky Doe. This is the fictional person that we're building a policy on. God forbid something happens to Bucky Doe at the end of year two. Well, his family is getting 535,000 minus any loans that would be out there. But you put in 60,000, the family's getting 535. I mean, death is hard to deal with, but that financial security and that protection would certainly help. So between all of those things, just know, we don't have to get into great details about this today, but just know if you don't have a policy, you haven't worked with anyone, you want to work with our team, we're going to put the time into understanding what are you trying to accomplish and how do we best design that for you. Now, there's a number on here that's circled, and it's this cash value at the end of year 10, 165,183. Just take note of that because that's going to be used later in our case study. Now, let me ask you a question. If this was a non-direct recognition company and we had taken out, say, $100,000 loan at year 6, how much of our cash value would be compounding year over year? Would it be the 106, or I'm sorry, the 106, or would it be something less? Non-direct recognition, how much is compounding? 106. Yeah. So in our example, if this was a non-direct recognition company, we take a loan, the full amount is getting dividend crediting. So that's the big thing to remember. Our full amount is getting dividend crediting. The rest of this case study we're going to run through is what does it look like if we do direct recognition. So let's jump into that. So use case number 1, let's just assume that we're working with a direct recognition company. We're taking a $25,000 loan, and guess what? We're never going to pay it back. Now, Chris, how many times do we tell people to take a loan and never pay it back?
Never.
Yeah, we don't recommend that. But I wanted to do this just so you could see the impact of the math. But just know, we don't expect you to take a loan and never pay it back. There are some use cases for retirement. Let's say that you've had a policy for 20 years, you get to retirement, and you want to do withdrawals. Those are different situations. But in the course of our lifetime, we want to use the policy as we would our bank, or we take loans, we pay them back, we buy a car, we pay the policy back for the cost of that car. So that's the motion. All right, so here we are with a policy where at year 1, end of year 1, we would have put in $30,000. We didn't take a loan at the end of year 1, and we've got cash value of about $26,140. This is the same policy I just showed you. The death benefit is $535,000. So what happens at year 2 is at the beginning of year 2, we're taking a $25,000 loan. There's going to be a 5% interest rate associated with that. So that's why you see 26,250 is we've got the 25,000 plus the 1250 of loan interest. So now at the end of year 2, we've got $26,250 of loan out. And guess what? In this situation, we're not going to pay it back, but you'll see the cumulative loan balance keeps going up year over year because we're adding interest onto that principal. So we go 27, 28, 30, and on and on. But here's the whole point of this. Direct recognition, we're not getting the full crediting of our dividend. So who can remember the number I told you to remember from the last slide? There was a cash value number. Does anyone remember what that was? 106,000. That is correct. So because we took this loan and we never paid it back and we let the interest accrue, instead of having 165,000 in cash value, we have 120. Now, if we did take a $25,000 loan from that previous example, that 165 would be showing 25 less, although we're still compounding on the full amount. Yeah, so the point here being is just this is showing what the impact of your cash value is by taking that loan. Now, to be fair, that 165 that we were talking about before, although the full amount is crediting and you're getting all the full dividends, the available cash value, if you had a $25,000 loan, would be subtracted from that 165 because the cash value is always showing you, just like a gas gauge, how much do I have left to use? The difference is how much is compounding in this case. So we will see an impact to our dividend, and we're seeing it at this 129.65. Now, this is kind of a worst case scenario because we're not going to teach you to take a loan and never pay it back. But there are situations where you might take a loan and you may not pay it back for 5 years. Maybe you're doing something with your real estate. Maybe you're paying some debts back and you're not going to pay your policy back until your debts are paid back. So the question would be, if that was you, would you rather have a direct or non-direct recognition policy if you're going to have the loan out for a long time? Yeah, so hope saying non-direct. So there are some cases where the the direct recognition isn't as impactful. And let's go through that as an example. So here's a direct recognition kind of comparison, if you will, of the 165,000 at year 10 versus our 120. So essentially what I'm doing is I'm showing the difference in cash value and the difference in death benefit. Okay. And I'm calling net cash value. What that really means is if you look at the policy with no loans at the end of year 10, we would have 165,000. If you look at the cash value at the end of year 10 with a $25,000 loan that never got paid back, we had 120,000. So the difference there is 44,218, right? If we just subtract those two numbers. But what I want to do is I want to take that $25,000 benefit, because if we took 25,000 from our policy, we went and bought a horse or we bought a car or we did an investment, it's still a benefit to us. So net, we really have a difference of 19,218. So that's why at year 10, you see 19,218 here. That's the difference between having a policy loan or not a policy loan and in a direct recognition. But look what happens over time. It just keeps getting worse. Our spread between what we could have earned and what we did earn is getting bigger and bigger over time. So in 25 years, if we never paid this loan back and we just let it roll, I mean, we would be looking at a difference in cash value of $84,000 in year 25. And I just want to stress again, we're not saying to do this. This is just the impact of what it would look like. And then your death benefit also, you can see it kind of creeping up over time as well. So your dividends and your death benefit, your cash value, I should say, and your death benefit will be impacted. Now I'm going to throw the disclaimer out there one more time, Chris, just because different companies will handle the dividend crediting and the interest. So we always have to remember that talk to your agent, your advisor, if you have a direct recognition, because they might be doing some interest crediting where maybe this impact is not 19,000, maybe it's 14,000 because you've got some interest crediting. So looks like Tess has been working some stuff in the background. She's got a picture of me and the horse. So, okay.
I think the best thing that this shows is if you're going to use direct recognition insurance companies, which there's no problem with them, they're great. And actually, one of the reasons why a lot of the competitors and why sometimes people will steer toward a direct recognition life insurance company is a lot of times they illustrate better. Maybe they show a higher dividend crediting rate or something to that extent. I can say that for a company called Penn Mutual, their illustrations almost always look the better. They are direct recognition. And I've rarely found a Penn Mutual policy design that has actually lived up to its illustration, when loans are taken out. So these are the considerations. And also another thing, if you're going to use direct recognition, the most important thing is you have to be an honest banker. So where we just showed you the impact of not paying the loan back. Now, if you were to pay the loan back, which we'll show you in a bit, that would be a drastically different looking picture. And you would be like, oh, that's great. So again, kind of like the late R. Nelson Nash taught, like be an honest banker, treat your money the same way you treat the bank's money. If you take a loan from your bank, i.e. your policy, repay your policy the same way you would have repaid the traditional bank or finance company for the car loan, horse loan, or whatever you're using the money for. That's the most important takeaway you can get when considering direct versus non-direct. And we'll get into more of the numbers, but I think that's my takeaway that I got from this.
Yeah, and Wendy, just to clarify, she's asking a question in the chat about if you don't pay your loan back, which is better, direct or non-direct?
Non-direct for sure.
Yep, non-direct. Because Wendy, what's happening is if you use direct recognition, that loan is impacting the dividend crediting, whereas on a non-direct, that loan would not be impacting your dividend crediting. Now, there's going to be some different situations where, maybe through the loan interest crediting on a direct recognition, there's not as big of a difference here, but like Chris said, if you were going to take a loan and never pay it back, it would be better to have a non-direct, in my opinion. All right, so let's go on to use case 2. And this is where we're still using the same policy design. We're still taking out a $25,000 loan, but we're doing what I would call quick recycling, meaning we took 25,000 out and maybe we went out and bought a car and we paid it back in a year or two. So the loan is getting repaid on a quicker cycle than what we just went through. All right. So the question is, how does this compare with scenario 1? We have to remember the loans are short duration loans that could be a year or less. The loans are being paid back in full. And so by having that loan out there for less time, we actually have less impact to the dividend crediting. So here we are at year 2, taking out a $25,000 loan. We have a difference in our cash value that year of $1,650. And then guess what happens? In year 3, we pay back the loan. Can anyone tell me why I took out $25,000 and I'm paying back $26,250?
Honest banker, paying yourself back with interest.
Yep, we're paying the policy back with interest. There was a 5% interest charge there. Yep. So we're back. We fully paid back the loan at year 3, and we're just going to do a new loan at year 4 and pay it back. Now, remember what the number was at year 10 on our previous example where we just took the loan out and never paid it back? It was $19,200, I believe. So we still have an impact at year 10 of $3,668. But because we're doing those shorter recycles, the taking the loans and repaying it back, you can see clearly the dividend impact wasn't as great. So if you have a direct recognition and you're taking loans and paying them back quicker, it's not necessarily a bad situation. We just don't want to have those going out for really, really, really long periods of time. So that's kind of what we're seeing on the quicker rotations of loans and paybacks. Oh, before we jump to that. So if you have a direct recognition policy, what do? Well, you can take loans, and what if you wanted to take a loan and not pay it back in a long time? And Chris, I know this next section, you have some of these types of setups with the cash value lines of credit, but maybe we'll just jump into it. So a cash value line of credit would allow you to take that direct recognition policy, put it as a piece of collateral to a bank that would then give you a line of credit on your cash value. But guess what? You're not actually taking a loan from the insurance company. You're taking a loan from the bank.
Bank. Yep.
Yep.
This is a topic that I used to talk about a lot when we were in a low interest rate environment. And then when interest rates went up, this was problematic for a lot of people. So we didn't talk about it. I never stopped using a cash value line of credit. So let me explain why. For me, it's completely a convenience mechanism. So I have lots of policies and I'm constantly taking loans and repaying loans. And when I had my, let's call it 12 policies, individually, I would be taking loans from all 12 and then repaying all 12. That's a lot of work. It's a very busy spreadsheet. So I set up a CV line of credit with a bank, okay? And we have several banks we work with. This is just one of them. We have many banks depending on the circumstances that the client has. But these banks specialize in cash value lines of credit. Think of it like a home equity line of credit. If you got a house and you got equity and you want the equity out of your house, you get a home equity line of credit. If you've got a whole life policy and it's got equity, i.e. cash value, and you want to access that cash value, these banks will give you a line of credit against the cash value. They will collateralize themselves by what's called a collateral assignment. Okay, so there'll be an assignment on your policy so that you have to pay them back before they're off the policy. So that's not a problem if you're just going to use it. But what that does for me is allows me to household 12 policies into one account. I have one point of entry to take money and one point of entry to return money back to my banking system. So for me, it's a convenience thing because right now my interest rate is 6.7% on my cash value line of credit, which is more than most of the insurance companies' loan interest rates that we charge, with the exception of one of them. But that one insurance company that has a higher interest rate than what the CV lines of credit are, like we talked to them, and I think that rate's going to start to come down just so that they can, become competitive. They did it more as a knee-jerk reaction and to an unknown or just a basically an interest rate environment that they couldn't predict where it was going. But anyway, nonetheless, the CV lines of credit are a great way for you to utilize the cash value in a direct recognition life insurance company, because then now you're not taking loans from the insurance company. So there is no recognition at all of a loan, because you're taking a loan from a bank and the bank is just collateralizing the loan with your cash value. So it's a great workaround. It's something I use. Is it something I say is right for everybody? No. If you've got 1, 2, 3 policies, you can absolutely manage loans from 3 policies. Piece cake. But if you've got 10 or, like more than that, a CV line of credit is the greatest thing since a slice of bread, because it's just so much more convenient to use. And that's all I have to say about that, Craig.
Yeah, and I would just add too, if you look at this particular bank's information, this is Coastal States Bank from October, so these numbers may have changed. But if you have a credit score of 750 or higher, they'll actually give you 100% loan to value. So oftentimes with the cash value line of credit, you can get more access to cash than you would if you went directly to the insurance company. So there's trade-offs, and in some of us in the IBC world, I mean, some folks will say, never do business with banks. Banks are bad. But in what Chris just shared, sometimes there's a convenience. Sometimes we want to get away from using the direct recognition pieces of the insurance company, so the cash value line of credit is a good option. So we wanted to kind of explore what the loans, how loans would impact your policy over time using direct recognition, but also offer a solution if you were in the case of having one of those. This is a viable option to look at. All right. So the next thing is we hear a lot of questions about loans. And so, Chris, if my loan interest rate is 5.24%, is that what I'm going to pay always, every time? Is that always
No,
what?
this is probably the biggest discussion I have with people, because I think it's just easy to get it in your head, right? Oh, the loan interest rate's 5.24, the loan interest rate's 7% from the insurance company, and we think that's exactly what we're paying, which it is, but it's what you're paying on the remaining balance on the loan. So when you really start to understand math and how loans work, there's a thing called an APR, annual percentage rate. That's the most important number we want to focus on. And that is why I'm trying to think of the parable or the thing, why it's not always what you see that is the truth.
Yeah.
Somebody else can put that parable in there, or that quote, whatever you want to call it.
All right. Well, for those of you that know me, I love spreadsheets. So we put this stuff into a spreadsheet, and what we're going to do, even though it's Tessa's birthday, 5/24, I guess, we're going to say what would happen with a $10,000 policy loan at 5.24%. All right. So here we are. We're going to run through a quick loan example. And essentially the way this is laid out is we're looking at the months, so we're looking at the first year. And the loan that we're going to take is $10,000. And you'll see in this loan principal repayment, we're not paying anything back to the loan. And we didn't pay the interest. Typically, when you have interest in your policy, that interest is paid at your policy anniversary. Anything you pay throughout the year is going to go towards your principal. So principal first, and at the policy anniversary, you can pay loan interest. So let's see how this kind of plays out. I have a $10,000 loan at 5.24%. In the first month, I have a principal balance of $10,000 and an interest balance of $44. So what we're going to be doing is taking that interest and kind of setting it aside, because our principal balance is going to remain $10,000 throughout the year. But you'll see that our interest charge keeps getting bigger and bigger and bigger and bigger, all the way to the point of, at the end of the year, if we didn't pay anything towards the loan, we have $524 of interest. And with some quick math, we know that that's 5.24%. Everything looks like it lined up. We have a $10,000 loan at 5.24%. We're going to pay $524 of interest. So that's scenario number one. Now, what we're going to look at is, what if we made repayments to the loan? We have a $10,000 loan, and now we're paying $500 back towards the loan every month. This could be $600, it could be $450. We're just using $500 as an example.
Yeah, that's a good thing to point out, Craig, is that when you are the bank, which is what we teach banking, folks. So when you're the bank, you set the rules. So if you took a loan for 10,000 from your policy, I mean, your loan repayment can be anything. The term can be any amount of time you want. It can be any rate you want. I always just say follow simple rules. If your policy charges you 524, then you should probably, earn more than 5.24 or repay more than 524, but you don't have to.
And what's interesting is when you make that $500 principal repayment, that's going to reduce your principal by $500. So you're not paying any interest at this point, but you see this box in the red. This was the interest charge when we weren't paying anything. So by paying $500, we bought that interest down from 44 to 41. You might say, well, whoopee, but the fact of the matter is what's happening over time is we keep buying that principal down. So now it's, say at month 6, it's 7,000. Month 9 is 5,500. So you have a difference in 393 to 295. That's really the interest that we bought down over time. The other thing that's noteworthy here is when you make that $500 principal loan repayment, guess what that does to your available cash value? It increases it by 500. So if I needed this money, a month later, I still have access to it. This is all liquid. So as we're paying that loan back, we're essentially filling up the available cash value that we can take a loan again. So it's not like it's a $500 loan payment that we lose. It's just going back into the cash value to increase that available amount that we can take again. So over the course of the year, we put $6,000 back into our cash value. We paid an effective tax rate, or not tax rate, but interest rate of 3.54%. So here's an example where although the insurance company's interest rate was 5.24, we actually paid 3.54. So by being an honest banker, we saved about $170 of interest. Now think about this at scale over the course of your lifetime, or if you're taking $50,000 loans or $100,000 loans, the picture just keeps getting better and better and better. So if there's any questions on that, shoot them into the Q&A, but I don't see anything right now. Looks like Mr. Nagy is here. And what would it look like if you, instead of paying $500 a month, what if you put $833 in every month? Well, now our effective interest rate is 2.4%. So what we're really showing here is that when you're an honest banker and you pay more and more back to your policy loan, you're not only filling up your available cash value, but your interest charge is actually going down over time. So the insurance company is getting this 2.4 and the rest of it's going back in your policy. So that's very important when we talk about being an honest banker and taking loans and paying them back over time. It's going to be more beneficial to you because you're paying less and less interest to the insurance company. However, guess what? Kind of kick this whole thing off saying in mutual companies, are we not sharing in the profits of the insurance company? So even that 2.4% in a roundabout way, it's still coming back to you in a roundabout way, I should say.
Yeah. So think of it this way. If all of your money is in the policy, compounding, uninterrupted, because remember, in this scenario, if we take the loan out, if it's a non-direct recognition company, we're still earning interest and dividends on the full amount, but we took the money out and then we're repaying the policy like we're showing here. And now your APR is 2.4. Did your policy earn more than 2.4? And if you remember from Craig's example that he gave you, I think it was year 4, it was cumulative. And in year 4, you made $1.20, which is essentially, if you put $1 in, you take $1.20 out, that's like a 20% cash on cash return. So how much are you making? Well, the spread, the arbitrage, you're making the difference in between. So the more you, and I love this because somebody asked me in the Q&A about repaying the loans, if you just operate like a bank and you treat your money the same you would treat the banks, and you're an honest banker like what we just showed here, you can see you're the one benefiting. You're the one making the money. It's very difficult for me to comprehend why somebody wouldn't want to pay the loans back, unless maybe rare scenarios where you take the loan from the policy, you buy a piece of real estate that you're renovating, there's no cash flow, no money, and then you got to wait until you sell the property. That's fine. You're waiting that period. But when you sell the property, be an honest banker and repay your policy with interest. That's why every time I take a loan, Craig, and I explained it in that video I started playing and then I put it in the chat, every time I take a loan, we do a note, like a physical promissory note. I, Chris Naugle, lent, sometimes it's Chris Naugle. I, Chris Naugle, lent Chris Naugle, $50,000 to buy a car at a rate of 6% or 7%. The interest rate I use is always just whatever the street's charging. So if I went to the car company or the car finance company and I said, what are you guys charging? And they said 7.4. Guess how much I'm repaying my policy back? 7.4. Why? Well, because that's what they were going to charge. So why would I pay myself any less than I'd pay them? Like, I'm more important than the car finance company. My banking system is way more important to me than XYZ Bank or Allianz Bank or, Bank of America. So why would I ever shortchange myself? Like, if I get all the money back, when I'm paying myself back, if all that money lands back in my bank account, should it ever even matter how much I pay myself back? Listen, like, I keep this simple, stupid. I don't overcomplicate this. When I lend money to my company, I charge my company 6%. It's just always what I've charged my company. When I buy a car using a loan from my policies, I literally ask or Google, what is the best interest rate on used car loans or new car loans? Whatever that comes up with, that's what I use. And I print out an amortization schedule or a schedule from bankrate.com. And then I sign the note, I literally sign the promissory note, kind of like if I'm in a bank and I'm signing the note to the bank, I do the same thing because I treat my money the same way I would treat the bank's money. It's so ingrained in me because I've created this habit and I've trained myself that. And that was one of my New Year's resolutions, was to be the bank. And when I said I was going to be the bank, that means I got to act and do as if I am the bank. It doesn't mean that I can sometimes pretend to be the bank. Like, I'm not pretending here, folks. Like, building wealth and getting your finances in the right place, it's not a pretend game. It's not like, cops and robbers back when you were a kid. This is a real freaking game, and a real game that will change your life in the future if you actually play the game right. And the game can be designed any way you want. There's no one set of instructions. It's not like, like when you buy Legos, like the instructions, you need glasses with bifocals just to be able to see where the parts go. But this is your game. Create the game the way you want. Set the New Year's resolution, set your objections. How do you want your bank to operate? Well, I want my bank to operate the same way Bank of America does, the same way, XYZ Bank operates. So if they're charging 7.4 for car loans, my bank is charging 7.4 for car loans. But when I pay my bank back, guess who gets the money? Me. I control the money. They don't. So that's the biggest thing you got to do, is so much of what we teach is just a mindset. It's literally just a mindset. And I know when people are new, it's just you're training yourself, but it's so easy to let your mind shift back over to the old way of thinking. And the old way of thinking, and the way most people look at this from the surface level before they understand the mathematics behind this, is like, it's my money. I saved that money up. Why would I pay interest on my money? And what they're referring to when they say that is, why would I ever put my money in a whole life when I got to pay 5.24% to take a loan of my own money? That's what they think. So let me just stop there. How many of you actually would think of it that way? You don't have to put it in the chat. I know there's some of you on here that would, or maybe when you first started, that's how you would have thought. But what you're failing to realize when you think like that, and Craig, can you pull up that one illustration where it showed the math of the cash value? What you're failing to realize is that all of your money in a non-direct recognition company or a direct recognition using a CV line of credit, all of your money is earning interest and dividends. So are you really paying 5.24%? Well, you really are paying 5.24%, but how much are you earning on that money? Well, over time, a lot more than 5.24, and we'll demonstrate that here. And also too, the 5.24 is a kind of a number that you are in control of, because like right there, you could get it down to 2.4, just be an honest banker. But just look at this projected cash on cash return, right? So every year after the second year, so second year, I put $1 in, I take $1.02 back, okay? Because I made basically 2% on my money. The next year, I put $1 in and I grow by 115. So how much was my cash on cash return? 15.83%. and it keeps going, 20, and then 26, and you can see the number keeps going up. That's just mathematics. That's compounding interest. This is what people don't understand. Anybody that says the infinite banking concept's a scam, anyone says that whole life is the worst place you could ever put your money, anybody that says any of that simply doesn't understand math, which I get it. Our schooling system, our education system is pretty broken. They don't teach people math in a real life scenario, but there's your math. So if you can't understand that that math makes sense, and you can't understand if I put money in here, I'm going to make those kind of cash on cash returns, even if I take all the money out. But if I take all the money out, it's going to cost me 5.24%. How many of you, if I gave you 15%, would mind giving me back 5.24%? None of you. If I said, I'll pay you 15% on your money, and I just want 5.24% back, none of you would have a problem with that. But then if I sweeten the deal and I said, hey, every year I'll pay you more, and you just pay me the same amount. So next year, after that 15% year, I'm going to pay you 20, and you just got to give me 5.24 back. Anyone not want that deal? How about a couple years later? I'm going to give you 37%, and all I want is 5.24%. Anyone not taking that deal? Every one of you would take that deal framed up that way. But the second I say, oh, well, you can have that, you just got to put your money in a specially designed whole life. You're like, oh, I don't want one of those. I don't want one of those. Really? Because a second ago, you said you wanted 37%, and all I asked for was 5.24% back, and you wanted that. But now that I just told you what it is that allows me to do that, you don't want it? Okay, bye. See, this is where I have to train my team all the time to understand who our client is not, so that I can understand who our client is. And our client is all of you. Those of you that take the time to understand how this really works. But you see, it gets even better because I seeded something for you you didn't even know. All I said was 5.24, 5.24, 5.24. You want to make even more money? Like if I give you 37%, you want to make even more and pay me less? Oh yeah, I want to pay you less, Chris. How do I pay you less? Be an honest banker. Be an honest banker. Pay your bank back. Pay yourself back with interest, just like you pay their bank back with interest. And then when you do that, remember that number, 2.4%. How many of you want me to give you 37%? You just got to give me 2.4% back. See, you're in control of that too. See, in the infinite banking concepts that we teach, you're in control of all this. And all you got to do is act as if you are the bank. Be an honest banker. Treat yourself treat your money the same way you treat their money. That should not be hard, but believe me, it is incredibly hard for people to wrap their head around this. Now, listen, I know we're getting to the tail end of this, and I want to be observant of all your time. We got some questions. I do want you all to know that we would be happy to jump on a call with any one of you, and we would be happy to jump on a call and basically go through how this would look for you. So if any of you are interested in doing that, we'll put the link up. It looks like Shauna just did. We will put the link up there so that you can book a call with our team. Now, here's the promise I'll make you. When you get on the call with our team's not going to sit there and try to sell you. It's not going to be one of those sleazy sale things where they bait and switch you. All we're going to do is we're going to learn what your needs and goals are, what you're trying to accomplish, what you want your financial future to look like. And once we understand all of that, we're going to basically show you how to solve your problem that you told us you have. And if we can solve your problem, guess what? All you need to do is ask us to. And that's how we operate, folks. Just ask us to help you solve your problem. But if we can't mathematically show you the reason why you should do this, then don't do business with us. And we won't do business with you anyway if we can't solve your problem. There is no reason for us to ever want to do business with you if we can't solve your problem. Zero reason for that. So again, folks, I just put it up there. I put a 90-minute video because today we just talked about direct versus non-direct. But if you want more about the infinite banking concept, because we've just brushed the surface, there's a video in there to watch. And then if you've already seen it or you're ready to book a call, then just go there and just book the call right there at the bottom. Just click that link, pick a day that works for you, and we'll jump on a call with you. And again, no strings attached, no sales attached. Let's just get down to the brass tacks. It's a new year. It's a New Year's resolution, maybe a new day resolution, but let's change your financial future in 2025 because this is going to be an interesting year. It's either going to be a year where people are going to get really behind financially, or they're going to get really ahead. You're going to have to pick and choose which one of those two options you want, but I already know which one you want. So get on a call with us and we'll be willing to literally show you the path on how that's going to work for you. Well, folks, we'd be trying to sell you something. Darn right we would. If we were slinging IULs, we would just be getting on the call trying to sell you, because all we'd be doing is selling a product. But what we're doing, folks, is we're creating a system, a process called the infinite banking concept. And that is just made better with mathematics that a whole life insurance policy can provide. What is an IUL? That's for another day and another time, but it's Index Universal Life. It's another insurance product that is sold primarily by stock-owned companies, if you remember that from the beginning, that solely want to put all the risk on you, Lucy, and not take on any risk on them. So if that's what you want, an IUL is a great product. If you want all the risk on your shoulders, great, buy an IUL, because the insurance company will love it because they don't have the risk and they pay the highest commission to the agent. So you're the agent that sells you the IUL, we'll love you for it. Where us, the way we design and engineer these whole life policies, we are not forced, but we do take a reduction in commission of anywhere between 60 to 90% so that you have 60 to 90% more cash value to use in your policy. Alex, I want to hit your question. Can you bring up the CV line of credit on Velocity Banking event you're doing with Christy Van? It's interesting, Alex. I don't know where it fits in what I'm teaching at Christy Vance. I could, but all I would say is don't use a CV line of credit, in this, because everything I teach at Christy's event is referring to just one policy. Sorry, I'm getting over the sickness. So if you just got one policy, I really don't ever want anyone to do a CV line of credit, because even if you had a direct recognition company, you just be an honest banker, and it really isn't going to make too big of a difference. The problem with the direct recognition, as Craig really drove home today, is if you just take a loan and you never pay it back. That's where the difference really starts to widen, because you're not being paid the full dividend on the cash value because you've taken the loan and kept it out. Now, if you're not going to take the loan, you're going to constantly be recapturing and recycling money to repay your loan. It's not as big of a deal. But again, chances are, if you get on the call with us, you're only going to be doing non-direct recognition, which would be One America, Lafayette Life, Mass Mutual, Security Mutual. The only one in that mix that I gave earlier that is a direct recognition company is Guardian. Guardian is an amazing life insurance company, mutually owned life insurance company, and we use them sometimes in New York. Why? Well, because New York just doesn't have many options. But we also use Security Mutual in New York, which is non-direct recognition. We also use Mass Mutual in New York, which is non-direct recognition. So there's lots of options. So chances are, with us, it's going to be very rare that you're going to bump into a direct recognition company anyway. But we just wanted to make sure that you knew, so that if you happen to do business with somebody else and they don't go through and explain it, well, now you're in the know and you have the knowledge. Thank you. Yeah. Thank you, Craig. Craig, I've done probably 6 or 7 videos on IULs, and you might throw up if you actually watch all 6 of them. So just try to limit your IUL content to at least 1 per day, just for your health reasons. If you watch too many of them all in once, you're definitely liable to get sick, and I don't want that for anybody.
Well,
But
I think
I'll try to fit it in.
Yeah, I mean, to the point of IULs. So, Chris, you've had a challenge out there for, I don't know what, 5 years, 4 years, about the $10,000 challenge.
Me and Chris Kirkpatrick, yeah.
Yeah. So, I mean, essentially, here's the deal. If somebody can show an IUL that has outperformed their illustrated IUL, from the start, was
From
over
10
the
years,
last 10 years,
10 years or a date, 10 years or any older than that, the longest bull run in history, which should be no problem.
So you have to show that your original illustration was outperformed, right?
Correct. All you have to do is show an in-force illustration that's 10 years or old or older that beats your original illustration. So, I mean, come on, the last 10 years have been gangbusters in the stock market. So if this should be just like, we should be writing checks for 10 grand to everybody, because in a bull run where the market's really high, your participation rate in an IUL should be really high. I mean, just, my gosh, the stock market this year, the S&P, if I'm not mistaken, maybe it was the Dow, did 23% this year. So if you had an IUL and you were participating in the S&P 500 that did 23%, dude, you're crushing it. And last year was double digits as well, and the year before. So all these years of positive returns, double-digit returns, if you're participating in that through an IUL, well, your performance definitely should be far better than the performance that your agent showed you 10 years ago, right?
And The $10,000 still has not been awarded. So
And we talk about it on big public forums all the time. Chris Kirkpatrick, he's always talking about it. And the reason some of you are like, well, why would you do that? What if somebody actually comes in and they want the 10 grand? We will gladly pay them the 10 grand. We will have one exclusion, and that is they have to come on and do a webinar with us. Because clearly, if there's one person out of thousands and thousands, or one agent out of thousands and thousands of agents out there that can show us one illustration that beats the original, they did something right. We want to know what they did right. That's worth 10 grand to us. Like, what did you do that was so amazing in this IUL that actually outperformed what you originally showed when thousands of other agents could not show us this? Like, please tell your story. Here's 10 grand. I mean, listen, you pay to play, but yet nobody's come forth. Nobody's come forth. That would have literally bought lots of Christmas presents for kids. Like if one of these agents came in, and agents are always trying to make more money and trying to make bigger commissions. Like shit, 10 grand just for showing 2 pieces of paper. Yep. Interesting, interesting. But what does that tell you, folks? It tells you that an illustration and the product, the IUL, doesn't work the way that it's being sold because it is hypothetical and just by sheer design seems to be built to serve the insurance company, not the client, which is the exact opposite of exactly where we started in today's training. And it's the exact same reason we're going to end on that note. And one of the things I want to do is I kind of want to just end on this right here. It's a new year. So look ahead with confidence, folks. Really now, this is just a stepping stone in your financial future and what you're learning. We're not sitting here saying that this is the end all be all, but this is one heck of a great first step. Okay, so we're going to continue to build on this throughout the year. Every week, every Wednesday, we do this. We also have a webinar every single Tuesday. We have 6 webinars we do every single week, but Tuesday is Take Back Control Tuesday. If you haven't been to that webinar, please check it out, especially if you're brand new. We had a bunch of people here for the first time. If you're brand new, check out Take Back Control Tuesdays. They happen every Tuesday at 1 p.m. Eastern, same time. And all it's going to do is walk you through the entire infinite banking concept, start to finish, the fundamentals. And then Wealth Webinar, we go anywhere we want to go, always bringing it back to money here on this show. So this show could be about treasury bonds. This show could be about real estate investing or private lending. But Take Back Control Tuesday is always about the infinite banking concept. So check that out. And again, one last time, I'll put the link up here if any of you want to book a call with one of our mentors to talk about how this would work for your financial future, do that. So get started, folks. Get started in your financial journey. You know, I say it so many times, but I'll say it one last time. I don't know where I'd be in my life if I hadn't found this. I really don't. That one chance question I asked at Cheesecake Factory so many years ago to Mike, and you know his answer, well, I lend from my own bank. And I thought he had a bank. I thought he owned a bank. I thought his family literally had a bank. Come to find out, all he did is think like and act as if he is a bank and do exactly what you just started to see the top surface level of today, which is known as the infinite banking concept. So with that being said, folks, thanks for joining us for the very first Wealth Webinar of 2025. And we look forward to seeing you at many, many more. Spread the word. Tell people to check my YouTube channel out at the Chris Naugle. And with that being said, thanks again. Bye. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.